2 minutes ago, a quiet economic earthquake began to ripple through Washington, not from a scandal, not from a speech, but from a single investor's analysis. Warren Buffett didn't shout, he didn't accuse, but he did something far more dangerous to fragile power structures. He made a prediction, one built not on ideology, but on economic math. And that math leads to a single chilling conclusion. The US economy is standing on the edge, and the people who once laughed at the warning are now whispering behind closed doors. If you care about your future, your portfolio, or just the financial survival of your family, you need to understand what's shifting underneath the surface. So let's break it down. For most of his life, Warren Buffett has avoided political theatrics. He doesn't raise his voice, he doesn't jump into the fray, he lets data speak for itself. And yet, when Buffett finally steps into a national conversation, not with drama, but with clarity, it always means something deeper is brewing beneath the surface. This wasn't a CNBC interview. This wasn't a shareholder letter. This was something far more deliberate. Buffett made a statement that sent tremors through both Wall Street and Washington, not because of how loudly he said it, but because of what it implied. The US economy is standing on the edge, and those in power either don't see it, or are pretending not to. What makes this moment different isn't just the content of Buffett's words, it's the fact that he chose to speak at all. For decades, Buffett has remained largely apolitical in public discourse, focusing instead on long-term investing principles, intrinsic value, and compound growth. But this time, something changed. According to those close to him, he felt compelled, not by ideology, but by patterns. Patterns in policy, in markets, and in capital flows. And those patterns, he noted, are beginning to diverge from any rational baseline. Buffett didn't warn of a crash. He didn't forecast a depression. What he did was more unsettling to insiders. He flagged a structural misalignment between economic fundamentals and political behavior. In simpler terms, he suggested the incentives driving today's economic decisions are no longer grounded in sustainable strategy, but in short-term survival. And that shift, subtle though it may seem, is what makes this moment dangerous. He referenced yield curves flattening in unusual ways, freight traffic slowing in economically sensitive regions, corporate debt expanding while productivity stagnates. But more importantly, he noted the breakdown of what he called the assumption of rationality. That's the silent foundation underneath markets, the belief that despite political chaos, economic decisions will still follow logic. And according to Buffett, that assumption is no longer holding. Behind closed doors, this sent shockwaves. Investors understand market risk. They even understand policy risk. But when someone like Warren Buffett implies that the entire structure is mispricing political dysfunction as economic strategy, it raises the stakes. It means portfolios built on traditional assumptions may no longer be protected by traditional hedges. It means that defensive positioning might not be about sectors or currencies, but about insulating from systemic irrationality. Why would Buffett say this now? Those who followed him closely know he rarely speaks to provoke. He speaks to protect, to warn before a major correction, and this time he said something he's rarely said so directly. The economy may look stable from a distance, but up close, the mechanics are grinding. Liquidity is thinning, volatility is being disguised by temporary optimism, and most dangerously, capital is moving in ways that suggest the biggest players are preparing for turbulence. He didn't mention Trump by name. He didn't need to. His message was broader. It was about the environment being created, one where decisions are made for political optics rather than economic viability. And in such an environment, Buffett warned, even the most resilient institutions can be blindsided by unpredictable outcomes. This wasn't fear-mongering, it was signal. A low-frequency alert meant only for those listening carefully. Buffett doesn't cry wolf. He observes patterns, and when he breaks his silence, it's because the math no longer adds up. That's why the warning matters, not because it predicts a specific date of decline, but because it reveals the growing gap between the narrative of strength and the reality of erosion. And that gap, once exposed, forces the world's most powerful investors to ask the question no one wants to ask. What happens when confidence dies quietly? It didn't begin with a press release. It didn't begin on a trading floor. It didn't even begin in Washington. It began, as many quiet economic shifts do, in a modest office in Omaha, Nebraska, a city more famous for cornfields than for triggering financial avalanches. But behind those quiet walls, Warren Buffett began drawing attention to something that many in power still refuse to acknowledge. At first glance, there was nothing unusual. The phones on his desk were silent. The markets, at least on the surface, looked stable. But what had changed, what made this day different, was what was missing. Signal consistency. Buffett, who's built his reputation on detecting subtle inflection points before they become headlines, had begun to notice a slow divergence between what policymakers were saying and what capital markets were actually doing. It was the kind of disconnect that doesn't break a system immediately, but weakens its foundation. The trigger wasn't a catastrophic event, it was data. Specifically, the kind of data that gets buried in footnotes and overlooked in mainstream headlines. Shipping volumes across key US. Corridors were beginning to decline. Inventory buildups were increasing in sectors that should have been moving product. Energy demand, typically a leading indicator of industrial activity, was flattening. But perhaps most importantly, Treasury yields were signaling something no press conference could cover up: investor doubt. Buffett had seen these signals before, not in the same form but in the same rhythm. It's a rhythm that emerges when optimism becomes overstated and the fundamentals begin quietly diverging. And this time, the stakes were larger than any individual asset or industry. This time, the shift was systemic. He called it what it was: a strategic misalignment. In his words, the US economy was behaving like a machine where the inputs no longer matched the outputs. Consumption was rising, but productivity was not. Corporate profits looked strong, but many of them were artificially inflated by financial engineering, not true economic expansion. And the most dangerous part? Policy decisions, particularly from the White House, were being made not for long-term advantage, but for short-term applause. This is where Buffett's concern deepened, because in his world, every economic choice has a price tag, and when a government uses policy not to solve structural issues, but to boost approval ratings or attack perceived enemies, the costs don't go away, they just get buried until they can't be buried anymore. From his vantage point in Omaha, Buffett could see the early signs that major institutions were beginning to reposition, not in panic, but in caution. Hedge funds were increasing short positions in cyclical sectors. Sovereign wealth funds were reallocating away from US debt. Even Fortune 500 boardrooms were slowing capital expenditure plans, delaying hiring decisions, and dusting off recession protocols. None of this was loud. That's what made it dangerous. Market euphoria often masks early withdrawal symptoms, and unless you're paying close attention, unless you're watching how capital moves at the top, you don't see the shift until it's too late. Buffett did see it, and he knew what it meant. The narrative coming out of Washington was one of strength, economic records being shattered, job numbers hitting new highs. But the deeper signals told a different story. One where growth was masking fragility, where deregulation had introduced just enough chaos to unsettle confidence, and where the rules of the game, trade, taxation, oversight, were now being rewritten not by economists but by tweets and talking points. This is why Buffett chose to speak. From Omaha, far from the noise, he could see the contradiction more clearly than most. And as he quietly began raising alarm, not in panic but with precision, a new phase of the economic story began. Because when long-term investors stop buying, it means something is already shifting. Most people misunderstood Buffett's statement the moment it reached the headlines. They thought he was predicting a crash. They thought he was warning of an immediate recession. They assumed he was talking about the stock market falling, about banks failing, about another 2008. But that wasn't his message at all. Warren Buffett is not a short-term prophet. He doesn't trade on fear or drama. He speaks only when the underlying structure of the economy begins to drift away from long-term stability. And this time, what he predicted was more subtle, and in many ways more dangerous than any single-day collapse. Buffett predicted a convergence of long-brewing pressures, a slow erosion, not an explosion. He warned that the US economy is entering a phase where political decision-making and economic fundamentals are no longer aligned, and when those two become separated, the entire structure begins to wobble. It's the kind of misalignment that doesn't show up in headline numbers, it shows up in behaviours, how corporations invest, how banks lend, how consumers save, how foreign governments allocate reserves, and what Buffett saw was a shift toward caution across every one of those fronts. What he actually predicted was a deterioration of confidence, the most critical pillar of any market system. Not confidence in America as a nation, but confidence in the reliability of American policymaking. Confidence in the rules not changing overnight. Confidence that the economy would be guided by strategy, not improvisation. Without that trust, the financial system doesn't collapse, it tightens. Money becomes slower, risk becomes more expensive, growth becomes harder. Buffett pointed to patterns forming across multiple sectors. Companies were reporting earnings that looked healthy on the surface, but buried in the footnotes were rising costs, tightening margins, and warnings about future uncertainty. That word, uncertainty, is the enemy of investment. When businesses cannot predict next year's regulatory environment, tariff landscape, or monetary policy direction, they stop expanding, they stop hiring, they stop building, and the economy gradually loses momentum long before the public notices. He wasn't predicting a sudden downturn. He was predicting a decade of hidden fragility if current trends continue. For example, he highlighted the rise of corporate debt that has outpaced actual economic output. More companies have been borrowing not to innovate but to survive, to buy back shares, or to maintain the illusion of growth. In Buffett's view, that creates an economy that looks strong but behaves weakly when stress arrives. A system built on leverage rather than productivity always hits its limits. He also touched on something few mainstream commentators discuss: political volatility as a form of economic tax, tariffs implemented without clarity, policy reversals that disrupt supply chains, regulatory swings that create chaos instead of guidance. These are not just political choices, they're financial shocks. Companies and investors price them in the same way they price natural disasters or geopolitical risks. Buffett predicted not a crash, but a reckoning. A period where the consequences of political improvisation catch up with the markets that have been propping up the narrative of strength. He predicted that investors, especially the biggest ones, would begin repositioning long before the public understood why. They already are. He predicted that supply chains would begin shifting out of uncertainty zones. They are. He predicted that capital would move towards safety with increasing urgency. It is. Most importantly, he predicted that America is approaching an economic edge, not because of one decision, but because of accumulated decisions that prioritize noise over stability, optics over fundamentals, and speed over strategy. Buffett didn't predict a fall. He predicted a thinning of the ice beneath our feet, and when someone like him says the ice is thinning, the smartest investors don't run, they prepare. Warren Buffett's prediction didn't include names. It didn't call anyone out. But make no mistake, those closest to Donald Trump felt the tremor. Not because he accused them, but because he did something far more destabilizing. He exposed the cost of their confidence. For years, Trump's most powerful allies, particularly in energy, real estate, shipping, and private equity, bet big on his political instincts. They weren't buying into ideology. They were buying into access, deregulation, tax breaks, and what they believed would be a sustained period of business-first policymaking. To them, Trump wasn't just a candidate. He was a political asset designed to unlock financial upside, and for a time, it worked. But Buffett's latest remarks changed the calculus. Because he didn't just challenge the policies, he questioned whether the strategy behind those policies was sustainable, and whether the people funding Trump were prepared for the downside they never priced in. His message hit where it hurts most: the return on political investment. It's important to understand who these donors are. These are not retail investors or grassroots contributors. These are billionaires managing enormous portfolios, industrial supply chains, and multinational operations. Their wealth is exposed to global flows of energy, currency, interest rates, and trade balances. When policy introduces unpredictability into those systems, unpredictability not offset by returns, the value proposition of political loyalty begins to shift. Buffett suggested something subtle but powerful, that Trump's political behavior was no longer producing net gains for his financial backers, and when Buffett says that, the donor class listens. Because in their world, money does not tolerate inefficiency. Several donors had already begun to notice what Buffett simply articulated, out loud. The trade war, for instance, may have been politically popular, But its market consequences were sharp and immediate. Steel tariffs temporarily helped domestic producers, but hurt downstream manufacturers. Agricultural exports faced retaliation, causing ripple effects across the Midwest. And while subsidies were issued as a band-aid, they didn't fix the long-term loss of access to global markets. The same applies to deregulation. While certain rollbacks in energy and environmental policy created short-term enthusiasm among oil and gas magnates, they also increased legal exposure and investor caution. Capital markets began penalizing companies seen as overly reliant on political protection. Long-term institutional capital prefers rule stability, not constant rewriting of frameworks based on election cycles. What Buffett's remarks did was connect those dots publicly. He reminded the world that investors, even political ones, calculate risk. And when risk outweighs reward, loyalty evaporates. It wasn't personal, it was mechanical. Buffett didn't say Trump's donors were wrong. He said they might have miscalculated. And for people who pride themselves on being the smartest in the room, that's a far more damaging message than any partisan attack. That's why Trump's inner circle grew quiet. That's why the word nervous began showing up in private conversations. Not because they feared Buffett's voice, but because they feared his logic would begin to spread. In the days following Buffett's comments, back-channel conversations began. Advisors asked fundraisers whether donor enthusiasm was slipping. Some top contributors started hedging their public support. Not withdrawing, not yet, but pausing. That pause is where the real threat lies. Political campaigns thrive on momentum, and momentum dies when money hesitates. Buffett didn't threaten Trump's base. He didn't need to. He held up a mirror to the donor class and asked one simple question. Are you still getting what you paid for? And when the people writing the checks have to think twice about that answer, the entire campaign structure begins to wobble. When Donald Trump took office, his approach to trade was clear: disruption over diplomacy. His team viewed global trade not as a network of interdependent systems, but as a zero-sum game, one America needed to win. And at the center of that strategy was the bluntest instrument in the economic arsenal: tariffs. At first, tariffs were framed as a negotiating tool, a short-term tactic to bring foreign powers to the table. But over time, they evolved into something else, a standing policy built on confrontation rather than collaboration. And that shift came with unintended consequences. Warren Buffett understood what many policymakers did not, that tariffs are not simply taxes on foreign goods. They are structural stress tests. When deployed aggressively, they don't just affect imports and exports. They ripple across supply chains, investor psychology, commodity pricing, and even the geopolitical landscape, and that's exactly what began to unfold. The first cracks appeared in manufacturing. American companies that depended on imported steel, aluminum, electronics, or machinery components saw costs rise. Some were able to pass those costs on to consumers, others weren't. Profit margins thinned, expansion slowed, and quietly, investment into capital projects was delayed. Then came the agricultural backlash. China, once a top buyer of US soybeans, corn, and pork, retaliated with tariffs of its own. American farmers, many of whom had supported Trump, watched as entire seasons of produce piled up without buyers. To contain the damage, the administration issued bailout packages totaling billions. But as Buffett later hinted, a subsidy is not a market. In other words, you can't replace long-term economic relationships with political patchwork. Foreign governments adjusted accordingly. China deepened its trade ties with Brazil and Russia. The European Union began exploring new trade pacts to reduce dependency on the US, and Canada and Mexico negotiated protections into USMCA that would insulate their markets from future executive tariff whims. Global trading partners had received the message: US trade policy was no longer predictable, and that was Buffett's core point. Markets can handle bad news. What they can't handle is unpredictability. The introduction of tariffs created a climate of uncertainty, not just for businesses shipping goods, but for every layer of investment decision-making. Should a factory be built in Indiana or Vietnam? Should a supplier in Shenzhen be replaced with one in Bangalore? Should a 5-year forecast assume today's tariff levels will hold, double, or vanish? These weren't academic questions. They were billion-dollar recalculations, and as Buffett explained, uncertainty has a cost, one that multiplies the longer it lingers. One of the most overlooked consequences was how these trade policies affected confidence in the US legal and regulatory system. By invoking emergency powers under acts like the International Emergency Economic Powers Act, IEPA, the administration bypassed traditional trade channels. This not only startled allies, it raised legal red flags that eventually caught the attention of the courts. As Buffett described it, the market's assumption that trade actions rest on solid legal ground cracked. And that crack, while quiet, spread quickly through legal departments and boardrooms worldwide. And let's not forget currency markets. The tariff era coincided with a weaponization of language from Washington. Accusations of currency manipulation, floated threats of labeling nations currency cheaters, and direct pressure on the Federal Reserve to intervene. All of it injected volatility into the dollar. For multinational companies holding assets across borders, this was yet another layer of risk that couldn't be easily hedged. Buffett's view was never partisan. He didn't oppose tariffs as a matter of ideology. He opposed them as a matter of efficiency. His core belief was this: economic tools must be used with precision, not politics. Tariffs, when deployed carelessly, don't create leverage. They create fragility. And fragility, once introduced, is hard to contain. Capital doesn't scream when it leaves. It doesn't tweet. It doesn't hold press conferences. It moves quietly, deliberately, and often invisibly, until the damage is already done. And right now, that movement is already underway. Warren Buffett didn't need to declare a capital exodus. He didn't have to. For those who know where to look, currency markets, reserve shifts, offshore flows, risk asset rebalancing, the signal is already flashing red. Capital is leaving certain sectors, certain jurisdictions, and in some cases the country altogether, not in panic, but in preemptive retreat. It's important to understand what capital flight actually looks like in today's world. This isn't the 1930s. You don't see lines of people exchanging cash at ports. Today, it's algorithms shifting positions in the night. It's sovereign funds reallocating 0.3% of $1 trillion portfolio from US bonds to Singaporean tech. It's multinationals pausing real estate deals in Dallas while greenlighting new campuses in Berlin. It's private equity firms holding back $1 billion in dry powder rather than commit to politically volatile US sectors. Buffett's comments weren't just a critique of policy, they were a map of movement. He identified something that those at the top already sensed. The environment in the United States, once considered the safest, most stable destination for capital, is beginning to show signs of unpredictability that spook long-term investors. It starts small. A hedge fund adjusts its risk model to add a wider band for US political volatility. A family office moves a portion of its holdings into Swiss francs, citing election year uncertainty. A board of directors delays a factory project until after the next administration takes office. Each individual decision seems trivial, but collectively they signal hesitation. And hesitation is the seed of capital flight. Buffett emphasized that markets can absorb high taxes, strict regulations, even short-term losses. What they cannot price in is chaos. Capital doesn't require comfort. It requires clarity. And when that clarity disappears, capital disappears with it. Consider the movement in treasuries, foreign holdings of US government debt, once the backbone of global financial stability, have been gradually declining. Nations like China, Russia, and even some EU partners have begun diversifying away from dollar-dominated reserves. Officially, this is done in the name of balance, but unofficially, it reflects a deeper unease. What happens if US policy swings wildly again? What if the Fed is forced into emergency action? What if Congress gridlocks during the next crisis? These aren't political fears, they're financial ones. Meanwhile, institutional investors are reallocating portfolios at a pace that seems minor on the surface, but reveals a shift in worldview. Risk-on sectors like US tech and real estate are seeing modest but consistent drawdowns. Capital is drifting toward gold, energy, and inflation-indexed foreign bonds. None of these moves are massive. That's the point. Large capital doesn't move all at once. It migrates, like a flock sensing the coming storm before the sky even darkens. Buffett framed it clearly. When people stop buying, something has already changed. He wasn't referring to retail traders or news-driven retail sell-offs. He was talking about the quiet hands, insurance firms, pensions, sovereign wealth funds that operate on 5, 10, even 50-year timelines. These players don't respond to headlines. They respond to structural signals, and the signal is flashing. Perhaps most revealing is where the money is going. Alternative jurisdictions like Singapore, Switzerland, and the UAE are seeing an uptick in private capital inflows. International real estate markets, especially those with stable tax regimes, are quietly rising. Even South American energy assets, long considered too risky, are seeing increased speculative interest. In every case, the trend is the same. Capital is seeking insulation from American unpredictability. And once that trend begins, history shows it rarely reverses quickly. At first glance, the US economy looks strong. Stocks continue to climb. Unemployment numbers remain low. Consumer confidence surveys show resilience. And corporate earnings, at least on paper, appear robust. If you only scan headlines or quarterly reports, the message is clear. The American economic engine is thriving. But Warren Buffett would tell you to look deeper. Because beneath the surface-level optimism, the foundation is shifting. And the numbers, once you strip out the noise, reveal something few are willing to say publicly. The real economy is not as healthy as the market wants to believe. There's always been a tension between market perception and economic truth. Markets are forward-looking, speculative, emotional. They respond to sentiment, liquidity, momentum. The economy, on the other hand, moves slowly, governed by fundamentals like productivity, wage growth, and capital formation. The two rarely move in perfect sync. But in recent months, the divergence has become harder to ignore. Buffett warned that the market has become detached from the very reality it's supposed to reflect. Take corporate earnings. On the surface, many companies are still beating expectations, but look inside the reports. You'll find profits propped up by cost-cutting, not expansion. You'll find buybacks, inflating EPS, while actual revenues flatten or decline. You'll find companies issuing cautious forward guidance even while celebrating short-term wins. In Buffett's words, it's not growth, it's theatre. Now examine the labour market. Yes, unemployment remains low. But that statistic doesn't capture the full picture. Labour force participation is still below pre-pandemic levels. Millions have exited the workforce altogether. Meanwhile, wage growth, when adjusted for inflation, has stalled. Many Americans are technically employed, but struggling more each month to stay afloat. The real estate sector offers another clue. While housing prices have remained high due to limited supply, affordability has collapsed. Mortgage rates north of 7% have priced out entire demographics, and yet builders remain hesitant to flood the market with new inventory, not because of regulation, but because of demand uncertainty. That's not a healthy housing market. That's a distortion. Then there's credit. Consumer debt is at all-time highs. Credit card delinquencies are quietly rising. Auto loan defaults are creeping up, and subprime lending channels are tightening. These are early-stage warning signs, the kind that Buffett has tracked for decades, indicating that the average American is no longer borrowing to invest in their future, but to survive the present. So why is the market still so optimistic? Because the market isn't always rational. It's driven by liquidity, and as long as capital remains cheap or plentiful, optimism can remain artificially elevated. The everything rally that followed the pandemic stimulus era has created a psychological flaw. Investors expect the Fed to save the market if trouble returns. They assume that any downturn will be brief. That confidence, Buffett warns, is the real risk. Because once the market believes it can't lose, it stops evaluating risk. And when risk is no longer priced correctly, misallocations multiply. Capital flows to speculation instead of productivity. Valuations rise beyond earnings potential, and bubbles begin to form, not in dot-com stocks or subprime mortgages this time, but in the belief that the system can absorb infinite political shocks without consequence. Buffett's quiet warning is that this optimism isn't sustainable. It's built not on fundamentals but on assumptions that policy will always bend to the market, that earnings will always bounce back, that consumers will always spend even as their savings dwindle, and that the Fed, despite its limits, will always ride to the rescue. But history shows something different. At some point, reality catches up, and when it does, markets don't just correct, they recalibrate. Buffett isn't calling for panic. He's reminding investors that gravity still exists. even when the market feels weightless. When Warren Buffett issued his recent warning, many listeners instinctively thought back to 2008, the last time America's economic engine failed in real time. It's an understandable reaction. The financial crisis of that era left deep scars. Millions lost homes, jobs, savings, entire institutions collapsed, and the ripple effects reshaped the global economy. But Buffett was clear, this isn't 2008. That doesn't mean we're safe. In fact, it may be more dangerous, precisely because it doesn't feel like a crisis yet. In 2008, the issue was visible once you knew where to look. Derivatives, subprime mortgages, over-leveraged banks. When the bubble burst, it was catastrophic. But it was also mechanical, a chain reaction triggered by mathematical pressure. A sudden failure, yes, but one that eventually led to aggressive correction, reform and rebuild. Today what we're facing is slower, quieter, more deceptive. It's not a bomb, it's a rot. And Buffett knows rot is harder to see, and harder to stop. In his analysis, today's problems are not rooted in reckless lending or toxic assets. They're rooted in systemic erosion, declining productivity, deteriorating trust in institutions, unpredictable policy decisions, capital misallocation on a national scale. This isn't about a broken banking product. It's about a broken incentive structure that's led to years of short-term decision-making. The key difference? In 2008, the trigger was private sector greed. In 2025, the fragility stems from political dysfunction. Buffett highlighted the fact that many corporations are now surviving, not through innovation or expansion, but through financial engineering. Stock buybacks, synthetic leverage, deferred investment. They're kicking the can forward, betting on a stable environment that no longer exists. Meanwhile, government policy is no longer acting as a stabilizer, but as a source of volatility. Tariffs, deregulation, emergency declarations, sudden shifts in economic direction based on electoral timelines, not economic conditions. This unpredictability feeds fear, and fear isn't just psychological, it's financial. It reshapes how capital is deployed, how businesses plan, and how international partners engage. This isn't 2008 because the system isn't freezing, it's drifting. And in Buffett's view, that's just as dangerous. Because a drift gives the illusion of progress. The stock market remains afloat. Earnings reports remain positive. Politicians boast about job numbers, but underneath, the fundamentals are weakening. Wage growth is stagnant, credit quality is falling, capital expenditure is softening, and trust in leadership in institutions in future returns is evaporating. Another critical difference? In 2008, the enemy was leverage. Today, the enemy is complacency. Back then, fear was visible, volatility exploded, panic selling dominated the headlines, but now markets continue rising, not because of confidence, but because of momentum. Liquidity continues to flow into risk assets not due to conviction, but due to habit. The belief that someone will step in, the Fed, Congress, the White House, has created a dangerous moral hazard. Buffett warns that this faith in rescue is misplaced. Unlike 2008, today's fragility isn't centralized. It's dispersed. Political trust, legal predictability, fiscal discipline, all of it has weakened across multiple institutions at once. There's no single villain, no Lehman Brothers moment. That makes it harder to diagnose and harder to repair. But perhaps the biggest danger, Buffett argues, is that no one feels urgency yet. The market isn't panicking, consumers are still spending, investors are still buying. But that's the illusion. In 2008, the fear came fast. In 2025, the damage may arrive slowly, and then all at once. This isn't a repeat of the past, it's something new. And if history teaches us anything, it's that the crises we don't recognize are the ones that hurt the most. For decades, the Federal Reserve has been the stabilizer of last resort. When markets wobble, when credit dries up, when banks begin to crack, all eyes turn to the Fed. It is the institution entrusted with maintaining economic equilibrium, moderating inflation, stimulating employment, and preventing systemic collapse. But Warren Buffett, in his characteristically calm, factual tone, just pointed to a reality that few in Washington or Wall Street want to admit out loud. The Fed is cornered, and there's no clean way out. This isn't a simple rate dilemma. It's not just about inflation running hot or growth running cold. This is about structural limitation, about being stuck between opposing forces so strong that any decision, whether to raise rates, lower them, or hold steady, now carries risk. Let's start with where we are. Interest rates are high, historically high for a post-pandemic environment. Inflation has been persistent. Despite 11 rate hikes since 2022, core inflation remains elevated. The cost of living has surged. Mortgage rates are above 7%. Credit cards are pushing 30% APR. Auto loans are nearing unsustainable territory. The Fed hoped that raising rates would cool the economy just enough to bring inflation down gently. A soft landing. But that landing is looking harder by the day. And here's where the trap begins. If the Fed keeps rates high, two things happen, neither of them good. First, borrowing costs continue to strangle consumers and small businesses. Credit becomes more expensive, debt servicing becomes heavier, defaults quietly rise. The economic engine, which runs on liquidity, starts to sputter. Growth slows, layoffs begin, recession risk climbs. Second, the US government, now sitting on over $34 trillion in debt, sees its interest payments explode. The cost of maintaining that debt is now one of the fastest growing segments of the federal budget. If rates stay high for too long, America doesn't just face an inflation problem, it faces a solvency problem. So why not just cut rates? That's the other side of the trap. If the Fed cuts rates too early, inflation could reignite. The recent price pressures on energy, housing, and food are not fully contained. A premature pivot would signal weakness, a lack of conviction. Markets might celebrate in the short term, but long-term credibility would erode. And worse, inflation expectations could become unanchored, which, in Fed terms, is a nightmare scenario. Because once consumers and corporations believe prices will keep rising, they change behavior. Workers demand higher wages. Businesses raise prices preemptively. That self-fulfilling spiral is almost impossible to reverse without extreme tightening. Which brings us right back to the first problem. Buffett described it without panic, but with precision. The Fed is operating with fewer tools than people realize. It has policy levers, yes, but it no longer has room for mistakes. And what makes this trap more dangerous than in previous cycles is the politicization of everything. Every Fed decision is now a headline. Every rate move is scrutinized through the lens of election cycles, media narratives, and market drama. The institution that was designed to be slow, methodical, and apolitical now faces constant pressure to fix problems it didn't create. Buffett's concern isn't that the Fed will panic, it's that the system around it already has. Traders front-run the Fed before it moves. Politicians blame the Fed for inflation while passing spending bills. Retail investors expect a bailout at every downturn. That's not monetary policy, that's dependency. So the trap deepens. The Fed must either trigger economic pain to regain control or accept longer-term damage to its credibility. There's no painless exit. And in Buffett's view, pretending otherwise only amplifies the risk. This isn't a critique of Jerome Powell or any individual governor. It's a recognition that the institution, once the bedrock of stability, now sits at the center of an economic paradox. Whatever it does next could make things worse. For over a century, the US dollar has been the undisputed cornerstone of the global financial system. It's the currency of international trade, the standard for reserve holdings, the foundation upon which global oil markets, debt contracts, and entire economies are built. But Warren Buffett, without drama or exaggeration, just pointed to a quiet shift that has serious implications. Global confidence in the dollar is not collapsing, but it is recalibrating. That recalibration, he suggests, is subtle. It doesn't happen overnight. It doesn't begin with headlines. It begins with behavior, with small adjustments by large players who rarely announce their moves but always plan decades ahead. Sovereign wealth funds, central banks, energy, exporters, global corporations, and right now they are slowly rethinking how much exposure they want to a dollar-dominated system that increasingly feels unstable. This shift isn't rooted in conspiracy. It's rooted in math and governance. America's fiscal deficit is ballooning. The debt-to-GDP ratio is at its highest since World War II. trillion-dollar deficits have become normalized, and every time Congress threatens a shutdown or flirts with default during a debt ceiling standoff, the rest of the world watches, not with panic but with quiet reconsideration. Buffett calls this reputational slippage. Not a collapse, a downgrading of expectations, the kind that doesn't trigger immediate exits, but starts to loosen the assumptions that once made the dollar automatic. Take foreign central banks. According to IMF data, global dollar reserves have fallen from around 71% in the late 1990s to under 59% today, their lowest level in nearly 3 decades. In that same time, gold reserves have quietly risen. So have holdings in the Chinese yuan, the Swiss franc, and even the Singapore dollar. Again, this isn't panic, it's insurance. These institutions aren't abandoning the dollar. They're hedging against the possibility that the US political system can no longer guarantee the kind of long-term stability that a reserve currency requires. And that's the real issue. A reserve currency isn't just about size, it's about trust. Trust that your debt will be honoured. Trust that your institutions are functional. Trust that your rules are clear and your politics restrained. Lately, that trust has been tested. The weaponization of the dollar, through sanctions, swift access restrictions, and capital controls, has made some governments rethink the risks of dollar dependence. The use of economic tools for political enforcement has blurred the line between finance and foreign policy. Countries like Russia, China, Brazil, and even US allies have responded by building bilateral trade agreements outside the dollar, and the energy markets are following suit. Saudi Arabia and China have discussed settling oil trades in yuan. India has started experimenting with rupee-based trade for regional goods. These are small moves today, but history teaches us that currency shifts begin with peripheral adoption and expand inward. Buffett isn't suggesting the dollar will be replaced tomorrow. What he's warning is this: the era of absolute dominance is fading, and when that dominance erodes, even slightly, the cost of capital rises. The premium America has long enjoyed, where it could borrow cheaply and endlessly without fear of currency retaliation, begins to thin. If the world demands a higher risk premium to hold dollar assets, interest rates rise, not because the Fed raises them, but because the global market demands more compensation for perceived instability. That means higher debt servicing costs, reduced global demand for US bonds, and tighter monetary options during crises. It also means America loses one of its greatest economic weapons: flexibility. Buffett has watched markets long enough to know that confidence is slow to build and quick to retreat. The dollar isn't in danger because of inflation. It's in danger because the world is asking a quiet, serious question. What happens if the safest asset stops feeling safe? You won't hear it on television. You won't see it trending. But behind closed doors, America's wealthiest investors, those with deep exposure to political outcomes, are no longer just funding campaigns or lobbying for favourable policies. They're hedging, not publicly, not in press releases, but in balance sheets, offshore accounts, asset reallocation strategies, and increasingly, in silence. Warren Buffett wasn't speaking directly to them, but he didn't have to, when he warned that the economic fundamentals are diverging from the political narrative. The billionaire class heard it loud and clear, because many of them had already begun to feel it. They weren't waiting for confirmation. They were already moving. This isn't about panic selling. This is about positioning, quietly, strategically, and globally. Billionaires, contrary to public perception, don't move like retail traders. They don't dump everything into gold or Bitcoin and announce the end of the dollar. They think in frameworks: multi-country exposure, intergenerational wealth protection, political risk modelling, and tax efficiency. And right now, that modelling is flashing caution. We're seeing signs everywhere, if you know where to look. Private jet traffic to jurisdictions like Switzerland, Dubai, and Singapore is rising. Trust formation in Cayman and Liechtenstein is accelerating. High net worth family offices are increasing their allocations to foreign real estate, physical commodities, and hard assets. And even among domestic holdings, there's been a pivot away from exposure to politically sensitive sectors like healthcare, education, and US infrastructure. Why? Because the billionaire class knows that while policies may shift, portfolios must endure. Many of these individuals backed Trump, or benefited from his tax cuts, deregulation, and America First trade policies. But loyalty, in finance, has a half-life, and what they're now witnessing is a different environment: rising scrutiny, market fragility, and increasing uncertainty not just from the White House, but from every branch of government. So they're hedging against all of it. Some are building redundancy into their corporate structures, setting up international headquarters as fallback options in case domestic regulation becomes unstable. Others are deepening relationships with foreign banks, increasing the portion of their holdings denominated in euros, francs, or even yuan. They're not making bets. They're building escape velocity, and they're doing it quietly for a reason. Publicly exiting US assets would trigger questions about patriotism, confidence, or political intent. But private capital rarely moves in headlines. It moves in shadows. Buffett knows this because he's seen it before. When the environment feels like it's tilting away from rational stewardship and toward erratic leadership, the smart money doesn't argue. It disappears. One hedge fund manager recently told a reporter off the record, "We're not abandoning America. We're just not pricing it at a premium anymore." That statement reveals everything. The shift isn't ideological, it's mathematical. Wealth, at this level, is less about making money and more about preserving it. That means reducing exposure to legal surprises, insulating from tax code volatility, avoiding regulatory chaos, and most of all, ensuring that their capital, built over decades, isn't vulnerable to one administration's impulse or one party's overreaction. Buffett wasn't criticizing them. In fact, he may have been warning for them. Because once billionaires begin hedging, not just in currency but in confidence, the ripple effects can be profound. They slow investment, they retreat from risk, they hollow out the domestic innovation engine without saying a word, and the public only notices after the capital is gone. Buffett's message was clear. These quiet shifts are not signs of collapse, but they are signs of calculation. A class of people who once believed in the system, because they helped shape it, is now preparing for what happens if the system turns on itself. And when billionaires start hedging, it means the storm is already overhead. Warren Buffett has never been known for political commentary. He's avoided party lines, campaign theatrics, and media noise. But his latest remarks on the US economy carried a tone that felt different, less about financial metrics and more about societal cohesion. Because when economic stress meets political dysfunction, the risk isn't just recession, it's fracture. And we are closer than most realize. At the surface, America appears politically divided, but stable. Two dominant parties, recurring elections, familiar institutions. But under that surface, pressures are building. And the kind of economic environment Buffett describes, one marked by slow erosion, capital retreat, and leadership uncertainty, is exactly the kind that accelerates political splintering. Here's why. When the average citizen sees markets rising while their paycheck shrinks, trust begins to break. When they watch billionaires quietly hedge while politicians promise recovery, the sense of betrayal grows. When inflation continues, credit tightens and public services lag, that breach between the governed and the governing becomes more than frustration. It becomes fuel. We've seen this before, not in collapse, but in realignment. Economic pain tends to reorder. Political coalitions, groups that once tolerated each other under a shared flag, begin to split. Rural versus urban, business versus labor, young versus old, insiders versus outsiders. And when the economic strain is persistent but unclear, when there's no singular villain like a bank or war, the blame fragments. Every faction points in a different direction. Buffett didn't explicitly say this, but the implications are embedded in his warning. If markets are detaching from reality, if the Fed is boxed in, if global confidence in the dollar is thinning, and if billionaires are already preparing exit strategies, then the middle class, the working class, and even parts of the upper class will soon feel cornered. And history teaches us something about cornered populations. They don't vote for moderation. They vote for rupture. Populism, both left and right, feeds on precisely this environment. High inequality, low trust, economic complexity with no clear answers. It's in this fog that outsider candidates rise, parties fracture internally, and legislative gridlock becomes the norm. And when no political actor can claim credibility on the economy, voters begin to look elsewhere, not just to new leaders but to new systems. This is the quiet risk Buffett alluded to, not revolution, but structural stress. We've already seen cracks in the system. States threatening to defy federal policy, cities taking economic matters into their own hands, and a growing wave of independents rejecting both major parties. If the economic uncertainty continues into 2026 and beyond, those cracks could deepen. It won't be one dramatic moment. It will be a series of subtle shifts. Governors refusing federal funding with strings attached, courts redefining executive powers, tech billionaires funding parallel political movements. None of it will look like collapse. All of it will feel like fragmentation. Buffett's concern isn't about GDP, it's about legitimacy. The kind of legitimacy that allows a country to disagree, loudly, but still move forward together. That thread, he seems to suggest, is fraying, not because of a single decision or event, but because trust, in markets, in leadership, in truth itself, is leaking from every institution at once. And when the economy turns from a unifying force into a dividing one, politics follows. Not instantly, not dramatically, but decisively. That's the fracture no one is pricing in, not a financial crisis, a civic one. And the scariest part? It's already underway. It's easy to track market numbers. Charts go up or down, volatility indexes spike, earnings surprise, treasury yields shift. But behind those metrics is something far less visible and far more dangerous: sentiment. And right now, Warren Buffett knows retail sentiment is approaching a critical threshold. Retail investors, everyday Americans investing through Robinhood, Fidelity, or retirement accounts, aren't just reacting to numbers, they're reacting to mood, to tone, to uncertainty. They're digesting headlines, social media, and peer anxiety in real time. And when that psychological environment turns from cautious to fearful, the market's foundation becomes vulnerable in ways data can't immediately explain. Buffett has seen this before. From the dot-com bust to 2008, and even during the brief but violent pandemic crash of 2020, he's observed how rapidly confidence can evaporate. And once it does, rationality doesn't guide the next move, emotion does. But what makes today different is how much more exposed and more emotionally involved retail investors are than ever before. Over the past decade, financial platforms have gamified investing. Fractional shares, meme stocks, crypto surges, and viral diamond hand culture brought in tens of millions of new retail participants. During the pandemic, stimulus checks and zero-commission apps flooded markets with novice money. Many of these investors never experienced a bear market. Many had never even seen a correction until recently. Now, they're waking up to a new reality. Inflation is eating into their real returns. Tech stocks are volatile again. Safe bonds don't feel safe. Crypto has lost its sheen. Real estate is out of reach. And while headlines still celebrate a resilient market, the average retail investor feels poorer, more anxious, and increasingly distrustful of the system. That psychological contradiction is exactly what Buffett is worried about. Because retail confidence doesn't vanish like institutional capital. With quiet asset reallocation or macro hedging, retail confidence cracks emotionally. It leads to panic selling, social contagion, forum-driven cascades. One viral video, one headline, one TikTok post about the next crash. And millions can move at once. And when they do, they don't just hurt themselves. They trigger systemic ripple effects. Consider the demographics. Baby boomers nearing retirement are watching their 401ks swing violently. Gen Z and millennials, many of whom entered during the bull market highs, now question whether investing was ever worth it. The middle class is squeezed between cost of living increases and falling real wages, and their first instinct is to retreat. That retreat doesn't just pull capital from the markets, it pulls optimism from the economy. Buffett has long said that markets are driven by two emotions: fear and greed. But in the retail world, the pendulum doesn't swing slowly, it snaps. And right now, sentiment indicators, retail fund flows, Reddit forums, retail options volume are showing a rising tide of confusion and distrust. And it's not just fear of a loss, it's fear of deception. Retail investors increasingly believe the game is rigged, that the wealthy have information they don't, that when billionaires hedge and policymakers fumble, they're the last to know, and the first to feel the consequences. That cynicism is corrosive. Once trust is gone, participation drops, and without participation, liquidity dries up. Volatility increases, the feedback loop worsens. Buffett's concern is not that retail investors will cause a crash, it's that they'll no longer believe in the recovery. Because once the average American stops believing that investing leads to wealth, and starts believing it leads to manipulation, the system loses something far more valuable than capital. It loses faith. And when that happens, no stimulus check or rate cut can fix it. Not because the math doesn't work, but because the belief no longer does. If you've made it this far, you understand something most people don't. This isn't about panic. It's about preparation. It's not about calling a crash. It's about recognizing the signals Warren Buffett sees and acting with clarity while others are distracted by noise. So the natural question becomes, what should you do right now? The answer isn't one size fits all, but there are universal principles that matter more than ever in this environment. Buffett has preached them for decades, and in uncertain times, they become your edge. Let's begin with the most critical principle. Don't react emotionally. Fear is the most expensive emotion in investing. It leads to impulsive selling, short-term decisions, and permanent losses. The headlines may be loud, the markets may feel unpredictable, but panic is never a strategy. Buffett's wealth was not built by timing tops and bottoms. It was built by identifying value and waiting. In volatile times, patience becomes a superpower. If you're investing with a 10-year horizon, a short-term drop is not a failure. It's a discount. Next, audit your risk exposure. You don't need to abandon the market, but you do need to know what you're exposed to and why. Ask yourself, are you over-concentrated in a single sector like tech or real estate? Are you relying on speculative assets that don't generate cash flow? Are you assuming the economy will keep behaving like it did in 2021? Now is the time to reallocate intelligently, not flee. Buffett often recommends quality over quantity. That means companies with pricing power, strong balance sheets, real earnings, and products people still buy during downturns. Look for durability, not hype. Then, build your liquidity wall. In times of uncertainty, cash is not just safety, it's opportunity. Having 6 to 12 months of expenses saved isn't just good personal finance, it's strategic defense. Liquidity keeps you from selling your investments during dips. It gives you optionality. It allows you to buy when others are forced to sell. Buffett's Berkshire Hathaway is sitting on over $157 billion in cash. That's not indecision, that's preparation. You don't need to match that, but you do need a cushion. Also, educate yourself continuously. Now is not the time to rely on social media hot takes or viral stock picks. You need signal, not noise. Buffett reads for hours every day, not to predict markets, but to understand businesses, trends, and human behavior. That's your edge too. Read real annual reports, study company fundamentals, understand how interest rates actually affect valuations. Learn about global macro trends, not from panic peddlers, but from data-backed sources. And most of all, zoom out. When Buffett talks about economic risk, he's not predicting apocalypse. He's warning that the margin for error has shrunk. The institutions we used to rely on, the Fed, Congress, the dollar, are all still functional, but less predictable. That's not a reason to run. It's a reason to be sharper. If you're an investor, invest with conviction, not convenience. If you're a saver, save with intention, not fear. If you're a builder, an entrepreneur, creator, or business owner, now is the time to double down on clarity. Because while the crowd gets louder, real wealth will be made quietly. Buffett always says, be fearful when others are greedy, and greedy when others are fearful. But the version that matters today is simpler. Be focused when others are confused. Because right now, clarity is your greatest asset, and the most powerful move you can make is staying calm when the world isn't.